Whenever traders ask me why the market seems to move so sharply when they least expect it, I tell them, you must listen to the story written in the volume. And today, as we build on the ideas we touched on right after the previous video on Amara stock Wyckoff breakdown, I want to walk you through the 7 volume patterns I use to anticipate the market's big turns, those quiet hints the tape gives before price ever makes its declaration. Now, as you listen, ask yourself, have you truly been observing the relationship between effort and result, or have you simply been watching bars rise and fall? Because that's where real market understanding begins. When I speak about volume, I'm not referring to mere transactions. I'm talking about the market's pulse. Volume tells you who's operating, the large informed interests or the uninformed public, and it shows their intent long before the movement becomes obvious. If price is the footprint, then volume is the weight behind the step. Without it, you're navigating by shadows. And why would any trader choose to work in the dark? The first pattern you must recognize is climactic volume. This is where the crowd and the professionals collide. You'll see a great burst of activity, a kind of emotional purge in the market. But the key question is, does price respond with the same level of intensity? If it does not, if the market hesitates or absorbs that energy instead, you may be standing at the turning of the tide. Climaxes are often the gateways to new movements, not the continuation of old ones. But a trader must learn to observe, not predict prematurely. The tape rewards patience far more than impulse. Next comes diminishing volume on reactions. When a market declines but shows less and less volume, I want you to imagine a runner running out of breath. Each downward step takes more out of the market, not less. Why is this important? Because if the selling dries up while price refuses to make meaningful new lows, someone strong is absorbing that supply. And who do you suppose that someone usually is? The informed, the prepared, the quietly accumulating professional interests. Then we have increasing volume on rallies. This is the mirror image of the prior pattern. When price moves upward and the volume expands, it tells us that demand is stepping in. But it's not enough to simply see higher bars. You must ask, does the price progress proportionally to the effort? If it does not, if the price hesitates while volume expands excessively, the market may be struggling under hidden supply. But when the two align, effort and result walking in harmony, you may be watching the early stages of something substantial. Another pattern is ease of movement. Some traders ignore it because it seems too subtle. But subtlety is often where the market's truth lies. If price rises easily on light volume, demand is present and supply is absent. The market lifts almost effortlessly. Have you ever felt price float upward in this way and wondered why? Well, it's because nobody's pushing against it. And that's the sort of silent confirmation that traders too often overlook while hunting for loud, dramatic signals. On the opposite side lies the pattern of heavy volume with poor price progress. This is a warning. When you see great effort, huge volume, but the market barely budges, someone strong is meeting that effort with resistance. It's like trying to push a door that looks open but is being held shut from the other side. Ask yourself in that moment, who is resisting this move, and why now? If the market meets your answer with silence, pay attention. Silence is sometimes the tape's way of whispering the truth. Absorption is another vital pattern. This is where supply or demand is steadily soaked up by larger interests. Picture price moving into a zone and stalling, the volume steady but not chaotic. The market is working through an obstacle. Many traders become impatient here. They want action, not preparation. But preparation is where the real moves begin. If you saw how absorption played out in the MRA stock Wyckoff breakdown, you'd recall how the market paused, gathered itself, and only then began to reveal the real direction. That same principle is the backbone of accumulation and distribution across all markets. And finally, there's the telltale pattern of the volume dry up. When volume thins to almost nothing, do not mistake it for inactivity. This is the market resting, coiling, conserving its energy. A low-volume environment, after a long preparation phase, often precedes a decisive move. Because once the last of the weak hands have been shaken out, There's no one left to stand in the way. The large operator merely needs to tip the scale, and the market responds. But again, I'll ask, are you treating low volume as a hint of what's coming, or dismissing it as unimportant noise? Your answer may determine your results more than any indicator on your screen. Throughout all these patterns, remember that volume is not a signal machine. It is a language. And the better you become at reading this language, the more confident, reasonable, and grounded your trading decisions become. You needn't chase quick gains or imagine that every setup will produce a windfall. What you truly want is consistency, clarity, and a calm, deliberate approach to capital growth. Wealth, when built through trading, is not the product of frantic prediction. It is the product of thoughtful recognition. The markets reward those who learn to see. As these 7 patterns begin sinking into your thinking, you'll notice the markets behaving less like chaos and more like a conversation being held between the strong and the weak, the patient and the emotional, the prepared and the careless. And if you choose to listen carefully, if you choose to study each bar with the same curiosity you bring to these discussions, you'll find yourself slowly aligning with the side that operates with intention. You see, many traders make the mistake of looking at the market as if price alone tells the story. They watch candles rise and fall, focusing only on the highs and the lows, the open and the close, thinking that's where the truth lies. But if you truly want to understand the market, if you want to operate alongside the informed interests rather than stumble after the public, you must learn to read volume. Volume is not just numbers on a chart. Volume is the market's pulse. It is the heartbeat that signals who is participating, who is active, and what their intent may be. When you understand this, you are no longer guessing. You are observing, interpreting, and acting in harmony with the underlying forces that actually move price. Now, think about this for a moment. How often have you watched a stock climb only to see it collapse shortly after? Or seen a decline that seemed unstoppable, only to find price suddenly stabilizing and turning around? In almost every case, if you had looked at the volume behind these moves, the answer would have been there. The volume tells you whether the market is being driven by professional interests, or if it is simply the noise of public speculation. Price without volume is like a conversation with no voice. It tells you what happens, but not why it happens. And in trading, understanding the why is the difference between consistent decision-making and random luck. When I say volume is the market's pulse, I mean it in the truest sense. Imagine a doctor trying to assess the health of a patient by looking at their movement alone, ignoring their heartbeat, their breathing, their vital signs. That is what most traders do. They look at price alone and miss the critical information that volume provides. Every bar of volume tells a story. It tells you whether the movement is supported or resisted, whether it is fueled by strength or exhaustion. When volume rises on a rally, it shows demand is entering the market. When volume spikes on a decline, it often signals that weak hands are being shaken out and stronger hands are absorbing the supply. The tape does not lie, but you must be willing to read it carefully and patiently. Ask yourself this when you see a large upward move. Do you immediately think, "This is my opportunity"? Or do you first ask, "Is the volume behind this move meaningful? Are the professionals involved, or am I merely witnessing public excitement?" That question is crucial. Volume separates action from reaction. It separates the move that is likely to continue from the move that is likely to reverse. Too many traders enter trades based solely on price action, only to find that they were dancing along with emotion, not logic. Understanding the pulse of the market through volume allows you to distinguish between the effort being applied and the results it produces. Volume is also a guide to market structure. When you observe it over time, you begin to notice patterns. You see how accumulation builds, often quietly and almost invisibly at first, with steady volume that does not produce dramatic price swings. You see distribution as strong hands gradually relieve themselves of positions, absorbing small price reactions and creating subtle pauses that most traders ignore. And you see climactic moves, moments when the volume suddenly surges, indicating the end of one phase and the possible beginning of another. Each of these situations has its own rhythm, and learning to recognize them requires discipline, patience, and careful observation. Many traders miss these signals because they try to force predictions rather than read the tape. Volume is not a magic crystal ball. It does not tell you exactly where price will go next. What it does do is provide context. It tells you whether the market is balanced or unbalanced, whether strength or weakness is dominating, and whether the professionals are accumulating or distributing. Once you internalize this, you begin to act in alignment with the forces that actually drive the market rather than fighting against them. You are no longer reacting, you are participating intelligently. Consider for a moment the relationship between volume and price trends. A strong upward trend supported by increasing volume is sustainable, at least until supply steps in to challenge it. A decline on rising volume indicates that selling pressure is significant and that weak hands may be capitulating. Conversely, when price moves with little volume, the move is suspect. It may be easily reversed because there is no real support behind it. This principle is consistent across stocks, commodities, and indexes alike. The pulse of the market, through volume, remains a reliable guide regardless of the instrument or time frame. Even in the most volatile markets, volume serves as an anchor. While price may swing wildly, the volume shows where effort is being applied. It tells you whether a rally is being fought against or whether it is being welcomed by the market. It tells you whether a decline is merely a temporary pullback or a genuine redistribution. And the beauty of this approach is that it trains the mind to think in terms of cause and effect rather than chance. You begin to see that price does not move randomly. It moves as a response to effort, and effort is recorded in the volume. I want you to imagine for a moment that each bar on a volume chart represents a conversation between the weak and the strong, between the public and the professionals. Each spike, each contraction, each pause is a word, a sentence, a paragraph in that conversation. And as a trader, your job is to learn the language well enough to understand what is being communicated. When you begin to see these patterns consistently, when you begin to interpret volume correctly, your trading decisions shift from impulsive reactions to informed actions. You start to recognize the signs of accumulation and distribution, the quiet absorption before a breakout, the subtle hesitation before a reversal. When I taught my students, I often ask, "Do you hear the heartbeat of the market?" Most would look puzzled. But those who learned to observe volume began to understand that the market speaks in a rhythm of effort and result. And if you tune your ear, you can anticipate significant moves long before they appear obvious on the price chart. You see, the pulse is always there. It never lies. It merely waits for those who are willing to listen. Volume also trains patience. Many traders want to jump in as soon as they see movement, but volume teaches you to wait, to observe the balance between supply and demand, to see who is winning the struggle at each level of price. Only when the effort matches the result do you have a signal worth considering. And that signal is not about guessing the top or the bottom. It's about understanding the context so you can align your actions with the market's rhythm. When you commit to observing volume as the pulse of the market, you also cultivate discipline, focus, and a realistic mindset about trading. You stop chasing, stop forcing, and start reading. You begin to see that consistent, intelligent decisions come from observation, not hope. And over time, that understanding compounds, just as your capital does, as you align more and more closely with the forces that truly move price. The market is never silent, and neither is its pulse. Every day, every session, the volume records the story of supply, demand, accumulation, and distribution. Your task is to learn to read that story, to interpret the meaning behind each bar, and to allow that understanding to guide your decisions. When you do, you are no longer a mere spectator. You are an informed participant in the ongoing dialogue of the market. Do you hear it now, the pulse? Can you begin to see that each spike, each contraction, each hesitation in volume is a piece of the puzzle, a whisper of the market's intention? When you truly embrace this principle, your perspective changes, and you start to understand that price may move, but it is volume that speaks the truth. Climactic volume. This is one of the most telling and dramatic patterns a trader can observe, yet it is often misunderstood. Many newcomers to the market see a sudden surge in price accompanied by huge volume and immediately think, "This is a trend I must chase." But let me ask you, have you ever paused to ask what that surge truly represents? Because climactic volume is rarely about continuation. It is a signal, a message, a warning written in the very pulse of the market. When you understand its meaning, you begin to see why the market often changes direction quietly, right after a seemingly unstoppable move. This is the kind of insight that separates informed traders from those who simply react to emotion. You see, climactic volume occurs when the public, driven by fear or greed, throws itself into the market in full force. They buy in a rush, driven by the excitement of new highs, or they sell in panic, trying desperately to avoid losses. But behind this emotional frenzy, the professionals, the strong hands, are at work. They use the public's emotion to their advantage, absorbing supply during panic or distributing stock into the excitement of a rally. So when you see an extraordinary spike in volume, you must immediately consider who is really controlling this action. Because what the tape is telling you is far more important than what the price alone suggests. The classic climactic pattern often shows itself as a vertical thrust in price with enormous volume. In a rally, it may appear as a rapid, almost vertical rise, with volume exploding beyond previous norms. In a decline, it may show as a dramatic plunge, again with a surge of activity that dwarfs anything that came before. At first glance, the casual observer might think this is simply momentum or a breakout. But the reality is more subtle. The professionals are testing the market. They are taking advantage of the emotional intensity of the public. They are allowing the market to reveal its weakest participants while quietly positioning themselves for the next phase. Understanding this gives a trader an almost unfair advantage because you begin to anticipate the market's reaction rather than follow it blindly. Notice that climactic volume is not just about size, it is about context. A huge volume spike in the middle of a sideways market has different implications than the same spike in the final stages of a long trend. In the latter case, it often signals exhaustion. The trend has reached its emotional peak, and the public has fully committed. The professionals, having accumulated or distributed according to their plan, now face a market that is top-heavy with emotion. Price may continue briefly, yes, but the probability of a meaningful reversal or consolidation increases dramatically. Ask yourself, have I been paying attention to these climactic moments, or have I been chasing the market blindly? Recognition is the first step toward alignment with the stronger hand. In addition to context, timing is critical. Climactic volume often appears at the end of an extended trend, after days, weeks, or even months of movement. It is not always obvious in real time, because the market's drama can disguise itself in small fluctuations before the sudden burst. This is why careful observation of both price and volume over time is essential. When you learn to identify the build-up to a climax, you see the early signs of imbalance, small but increasing volume on the last rallies or declines, hesitation in price progress, or abrupt spikes during minor pullbacks. These are all the market whispering, "Pay attention, something is about to change." Consider for a moment how this ties back to previous discussions, like the MRA stock Wyckoff breakdown. Remember how we analyzed the moments when price accelerated on heavy volume? Those were not random, they were signals of a climactic process in motion. The large operators were actively managing supply and demand, absorbing or distributing stock, while the public rushed in with emotion. If you missed that, you missed the lesson that climactic volume is less about price direction and more about the battle of interests behind the scenes. Recognizing it allows you to stand aside, or better yet, position yourself on the side of the informed participants. Climactic volume also teaches patience. Many traders want to act immediately on these spikes, believing that sheer size indicates opportunity. But the truth is that the most profitable approach is often to wait and observe the market's response. After a climactic event, price usually pauses, consolidates, or even reverses slightly before the next significant move. if you can resist the urge to jump in too early, if you can interpret the volume as a message rather than a signal for impulsive action, you gain clarity and control. The market rewards those who wait and read, not those who leap blindly on emotion. Another important aspect is the divergence between price and volume. During a climax, price may still continue in the direction of the trend, but if the volume becomes excessively heavy without proportional progress in price, that is a red flag. The effort is no longer producing the expected result. This is one of the key principles of Wyckoff's approach, effort versus result. It is not enough to see high volume. You must assess whether that effort is actually moving the market. If it is not, the professionals are likely absorbing or distributing, and a reversal may be imminent. The tape, in this sense, is far more reliable than any opinion, prediction, or news headline. It tells you what is actually happening in real time. Climactic volume is also a reminder that trading is not about impulsive profit seeking. It is about understanding the balance of power in the market. The emotional public is predictable. They buy in enthusiasm, sell in panic. But the professionals operate with strategy, patience, and foresight. If you align yourself with the stronger hand, if you learn to recognize climactic volume and interpret it correctly, you begin to participate intelligently rather than react blindly. Your trades become deliberate, grounded in observation and analysis, not speculation or hope. Now, consider the rhythm of the market. Every trend builds energy, every move has its purpose, and climactic volume is often the punctuation mark at the end of that sentence. It is dramatic, yes, but it is also informative. If you can learn to read that punctuation, to understand the message it conveys, you will see that the market is always communicating. And when you read that message accurately, you begin to make decisions that are both disciplined and in harmony with the market's underlying forces. Diminishing volume on declines is one of the most telling signs a trader can observe, yet it is often overlooked or misinterpreted. Many beginners see a downtrend and assume the selling pressure is relentless, that the market is moving with unstoppable force. But here's the critical question you must ask yourself. Is this decline showing true conviction, or is the energy behind it fading? Because when volume diminishes as price falls, it signals something far more significant than a simple pullback. It tells you that the weak hands are exiting, that the selling pressure is being absorbed, and that the professionals, the informed interests, are quietly stepping in. This is the subtle, almost invisible work that sets the stage for the next meaningful move in the market. Think of it this way: when a market declines on heavy volume, every participant feels the pressure. Panic spreads, and traders flee to the sidelines. But when the decline continues while volume shrinks, it is not panic, it is a quiet absorption. Someone strong is quietly taking control. They are allowing the public to release their positions while they consolidate stock in preparation for the next upward move. This is the very principle that separates the informed from the uninformed, the disciplined from the reactive. Ask yourself, am I noticing when the market's energy is fading, or am I merely reacting to the direction of price? Diminishing volume on declines also illustrates a fundamental Wyckoff concept: effort versus result. Price is moving lower, yes, but the effort behind that move is lessening. The market is essentially saying, the selling has lost its force. There's not enough energy to push me down further. When you observe this pattern, you begin to understand the battle of supply and demand. The supply that created the prior decline is being met by demand from stronger hands, and the market cannot continue to drop without a fresh influx of sellers. This is why recognizing the pattern of diminishing volume is critical. It provides a clue about where the market's balance of power is shifting. Many traders fail to see this because they focus only on the price chart. They see lower lows, assume momentum is bearish, and pile into short positions. But without examining volume, they miss the real story. The decline may be faltering, the energy behind the selling is waning, and the stage is being set for accumulation. Observing volume gives context. It allows you to differentiate between a true bearish trend and a market that is merely absorbing supply before resuming an upward trajectory. If you are attuned to this, You gain insight into the behavior of professional traders who quietly absorb supply while the public panics. Ask yourself, have you been paying attention to the subtle signals, the small contractions in volume that precede a turn? Because these are often more reliable than dramatic spikes. Climaxes grab attention, yes, but it is the quiet, diminishing effort on declines that often signals real opportunity. It is in this subtlety that the market reveals its intentions to those willing to observe carefully. When volume diminishes as price declines, the market is effectively whispering to you. The selling pressure is exhausted. The smart hands are preparing for the next move. This pattern also ties directly into risk management. Entering trades when the decline shows diminishing volume is far safer than chasing after a heavily sold market. You are positioning yourself in alignment with the underlying forces, not fighting against them. The informed interests are absorbing, preparing, and consolidating, which means you have a window to participate with a favorable balance of risk and reward. Ignoring this pattern, on the other hand, is like charging into a storm blindfolded, assuming that the visible motion tells the whole story. Another important aspect is the relationship between time and volume. Often, a decline on diminishing volume does not happen in one swift move. It occurs over several bars, perhaps even over multiple sessions. This slow absorption allows the professionals to accumulate without causing panic-induced spikes in price. For the observant trader, this is an invitation to study the behavior closely. When is the market hesitating? When does volume contract during a downward movement? Where does price pause? And what does that tell you about supply and demand at each level? The answers are all recorded in the tape, waiting for those who take the time to see. Diminishing volume on declines also teaches patience. Many traders become frustrated when the market seems to stall or move slowly. They think the opportunity is gone because the move is not dramatic enough. But in reality, the market is quietly preparing itself. The public may be panicking, the emotion may be running high, but the professionals are deliberate. They absorb the excess, they distribute stock carefully, and they build the foundation for the next significant move. Understanding this helps you avoid impulsive trades and encourages a more thoughtful approach. Consider also how this principle connects with patterns you may have studied previously, like in the MRA stock Wyckoff breakdown. When price fell but volume contracted, it was a sign that the selling was being absorbed, that the market was readying itself for the next phase. Observing diminishing volume in that context allowed you to see beyond the obvious downward price action and to anticipate that accumulation was taking place. This is the subtle intelligence that Wyckoff emphasized. The market story is rarely told in dramatic movements alone. It is often whispered in the quiet, diminishing effort behind a decline. Recognizing this pattern also improves your ability to interpret other volume-related signals. When you notice diminishing volume on declines, you begin to see the market's ebb and flow. You notice when supply is absorbed, when demand quietly steps in, and when the market is preparing for a rally. You begin to read the market's rhythm rather than reacting to individual bars in isolation. This is the foundation of disciplined trading, of making decisions rooted in observation rather than emotion, and of aligning your actions with the forces that truly move the market. Diminishing volume on declines is a signal of quiet strength. It reminds us that the market does not always reveal its intentions in obvious ways. It rewards patience, attentiveness, and disciplined observation. Traders who learn to see this pattern understand the subtle balance of supply and demand, the absorption by stronger hands, and the preparation for the next meaningful move. Increasing volume on rallies is a principle that every trader who wishes to operate intelligently must understand deeply. Many beginners see a price rising and think that the move alone signals strength, but price without context is incomplete. Volume is the proof behind the motion. It is the market's voice confirming the legitimacy of the rally. Ask yourself, when a market climbs, is it being carried by genuine demand? Or is it merely the illusion of momentum generated by the uninformed public? Because this is the difference between a rally that can sustain itself and one that collapses under the first sign of resistance. Recognizing increasing volume on upward movements allows you to see the alignment of effort and result, which is the heartbeat of Wyckoff's methodology. When price rises in conjunction with expanding volume, it tells you that demand is actively entering the market. The informed interests, the professionals, are stepping in and supporting the move. This is not accidental. Volume confirms conviction. If price rises but volume does not follow, the rally is weak, vulnerable, and potentially misleading. The tape speaks clearly. Effort must produce result. The stronger the volume backing the rally, the more reliable the price movement becomes. As a trader, you must be attuned to the size, speed, and timing of these volume surges. A minor uptick in volume on a small rally tells a different story than a massive expansion coinciding with a decisive move through resistance. Understanding these subtleties is what separates intelligent participation from speculative guessing. Now, notice that increasing volume on rallies often occurs after a period of preparation. The market may have been consolidating, absorbing supply, or digesting previous declines. When the rally begins and volume expands, it indicates that the absorption phase has completed and demand is asserting itself. Here is where the novice trader often errs. They see price moving upward and jump in too early without considering the context or the underlying volume. The informed trader, by contrast, looks at the totality of the tape. They ask, is this rally backed by genuine buying interest? Are strong hands reinforcing this move, or is it the emotional rush of late entrants? These questions are critical because they shift the trader's mindset from chasing price to interpreting intent. The principle of effort versus result is central here. Increasing volume on a rally is evidence that the effort being applied, buying pressure, is producing the expected result, rising prices. When the two are in harmony, you have confirmation that the market's internal forces are aligned in favor of the trend. If volume lags behind price, however, the effort is insufficient and the move may stall or reverse. Many traders fail to recognize this alignment because they focus exclusively on price. But a rising bar without corresponding volume is like a river running dry. It looks impressive from a distance, but the energy supporting it is weak. Observing volume ensures that you are acting in accordance with the market's underlying reality, not a superficial illusion. Consider also the role of psychology. When volume increases during a rally, it is not merely numbers on a chart. It represents the crowd's behavior and the actions of informed participants. The public may jump in late, adding to the volume, while the professionals support the move strategically. This combination creates a self-reinforcing dynamic. Price rises, volume rises, and confidence builds. But a wise trader observes not just the enthusiasm, but the proportion of effort to result. They watch for subtle signs of overextension, such as exaggerated volume spikes that fail to move price proportionally. This tells the observer that supply may be entering the market quietly, that the rally could be approaching a point of resistance. Increasing volume on rallies is also instructive when looking at trends over multiple time frames. On daily charts, you may see a series of advancing bars with growing volume, indicating strong institutional participation. On intraday charts, the same principle helps you identify high probability entries where demand is overpowering supply. Volume acts as a magnifying lens, clarifying which moves are genuine and which are temporary exaggerations. The market is always testing, always balancing, and volume is the clearest reflection of that process. The more familiar you become with this dynamic, the better you become at timing your actions and managing your risk. Remember how we discussed the MRA stock Wyckoff breakdown in the previous video. When price rallied on increasing volume, it was a signal that demand was asserting itself after absorption of prior supply. Observing the growth of volume allowed you to anticipate not only the continuation of the move, but also the areas where professional interests were reinforcing it. This connection highlights an essential truth: price without volume is incomplete, but volume in context tells the story of the market's next likely phase. A rising bar backed by increasing volume is a confirmation of strength. It is a signal that the market's internal forces are in harmony, even if the public does not yet fully understand it. Increasing volume on rallies also provides a framework for disciplined decision-making. It teaches you when to participate and when to wait. Traders who ignore this pattern often enter too early, chasing price without confirming support, and are quickly stopped out. Observing the volume ensures that your entries and exits are informed, based on real market behavior rather than emotion. You begin to think in terms of supply and demand, absorption and distribution, rather than reacting to candlestick patterns in isolation. This shift in perspective is not just technical, it is strategic. It trains the mind to anticipate, rather than chase, and to act in alignment with the forces that truly move the market. The subtle variations in volume during a rally can also reveal deeper insights. A steady, progressive increase in volume indicates gradual accumulation and confidence in the move. Sudden spikes, on the other hand, may indicate the public's emotional response or the absorption of last-minute supply. A skilled trader interprets both scenarios, understanding that the market rarely moves in a straight line and that each volume pattern has its own implication for future price behavior. Increasing volume on rallies reinforces the value of observation over prediction. It reminds us that the market communicates in real time, that every bar of volume has a story, and that the trader's role is to interpret that story accurately. When you internalize this principle, you are no longer reacting to price alone. You are participating intelligently, aligning your actions with the market's pulse.